While it's fun to make videos on new stocks, on Tesla, on the Coinbase IPO, on things going crazy with crypto, and a massive potential that can generate massive gains in my portfolio, I've had some pretty cool gains. And it's great talking about what these are and how you can potentially leverage and kind of try to copy what I'm doing in my portfolio. But here's the thing, right? News, headlines, and hype, it's all fun to consume. Our brains want it. And those videos have always done better on my channel, but I'm not sure they're the most important ones for you to watch. So in this video, I want to uncover some massive myths in investing and how so many people are kind of being misled by the media. Who's to blame with all this, right? And our focus kind of has been taken out of context when it comes to investing. Someone that has unintentionally led to massive confusion in the marketplace is Warren Buffett. So many people invest the exact opposite way that Warren Buffett would recommend you invest. And worst of all, they're doing it because they think that that's what Warren Buffett would have wanted. So let's unpack this and let's figure out what he wants, what he would recommend for you to do to invest. Now, if you look anywhere online, you're going to see that hype wins the clicks. Hype is what gets the eyeballs, hype is what gets the traffic, the ad revenue, and the craziest thumbnails are the ones that get the most clicks, right? The most insane headlines get the most reads. The juiciest stories are the ones that get the most shared. We love drama. And this video, though, is not going to be crazy, it's not going to be insane, and it's not going to be super juicy. But I think it will be important. I don't have Patreon. I'm not recommending you to join Webull to get some free stocks. I'm not going to pitch you a course for you to buy. All I want you to do is get this video in front of more people. Like it, share the video so it helps the algorithm, comment as well. You engaging in videos like this, and that's going to help them grow by liking and subbing. That's a fight against clickbait, right? That's a fight against hype that has led so many people down bad investing decisions. So I'd really appreciate if you just take a second, click that like, click subscribe, and let's get to it. Warren Buffett is known as one of the best investors in modern history based on his results. He is someone that without a doubt has had tremendous success. And what the heck is the point of doing something different than Warren? Like, shouldn't we just be copying him? Shouldn't we just be stock picking because he's doing it? Shouldn't we just be investing in dividend stocks? Aren't those just the best because he's doing it? Now, the issue is that a lot of stuff gets taken out of context. Warren Buffett is not the reason you should pick stocks and not the reason you should look for dividend paying stocks. So let's uncover the first thing, stock picking. Knowing what to buy and what to sell, right? There's also knowing when to buy and when to sell. We'll cover that too. In 1996, in the Berkshire Hathaway letter to shareholders that he does every year, he wrote that most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results after fees and expenses delivered by the majority of investment professionals. So what he's saying here is just buying an index fund that has little fees instead of trying to pay someone to buy and sell and actively make good decisions on stock picking. Now, the next thing that you should kind of know about is the goal of the non-professional, which is you, should be not to pick winners, okay? Nor he or his helpers can do that. His helpers, by the way, so it's a little low-key little poke in the ribs there too. The helpers are the brokers, the active managers, right? He's saying, hey, the helpers can't even do that. You should rather be owning a cross-section of businesses that in aggregate, in total, are bound to do well. A low-cost S&P 500 index will achieve that. Now, the money he cares the most about is probably the money that he's going to pass on to his family. And here's his advice to his trustee. Here's what he is saying. This is what you're going to do with my money after I go. You're going to put 10% of the cash in short-term government bonds and 90% of it in a very low-cost S&P 500 index fund. I suggest Vanguard's. We'll talk about what that exact is so you can buy it if you want. I believe the trust's long-term results from this policy will be superior to those attained by most investors. whether pension funds, institutions, individuals who employ high-fee managers. Okay, so he knows the industry, and this is what he's doing with his money after he passes. And in fact, he actually did a very public bet, which was really embarrassing to the hedge fund industry. And basically in 2008, he issued $1 million bet to charity and said, hey, if you can beat the S&P 500, I'll donate $1 million. If you can't, you donate $1 million. And there were 5 hedge funds that participated in this, picking stocks. And over 10 years, Warren said, you know what? I know what's going to win. I'm just going to buy VFIAX, okay, which mirrors the S&P 500, and that's going to beat all of your hedge funds who have billions under management and are buying and selling and thinking that they're the smartest guys in the world, which they are very smart, but this shows you how friggin' hard it is. What happened? Well, Ted Seeds, the main guy that he made this bet against at Protege Partners, he conceded defeat ahead of the contest schedule wrap-up. So he basically said, I give up before the thing was even over. For all intensive purposes, the game is over, I lost. The S&P 500 index outperformed a hand-picked portfolio of hedge funds over 10 years. These are some basic investing principles. Passive investing versus active investing. There's way more money in active investing. It is hard to find an article here that tries to not start spinning things and be like, hey, well, you know, maybe the next 10 years would be different. Maybe, look, overall, the longer the time period, the more the S&P 500 beats these hedge funds. It's insane. The money is in the active investing because why the heck is there's this whole industry of people saying, hey, give me your money and 1% of fees and I'm going to beat the market. But the truth is that's not what happens 95% of the time. So what was this test? Well, this was VFIAX. This is what he bought, the S&P 500 Admiral Fund by Vanguard. So this is what it looks like right here. You can buy this too, but I'm going to tell you something else that you can buy that's going to be easier for you. This is the 500 Index Fund in Admiral shares. This has an expense ratio of 0.04%. The average expense ratio, when you give it to an active fund manager, could be like 1% or 2%. So this is literally like 30x cheaper, 40x cheaper than an active investor. And on average, they beat them even without the fees. So this owns basically 509 stocks, the S&P 500. It owns them in a percentage based on their market cap. And by buying this, you basically own all of them, or the results of all of them. What you can do right here is you can click this, available as an ETF. This is a more beginner-friendly way to buy the S&P 500. It also has a cheaper expense ratio. This is VOO. VOO is an incredible ETF, and that is one in which I have personally bought quite a bit of. So notice that is what he thinks you should be buying. So that is, by the way, just an S&P 500 ETF. There are other ETFs that have higher dividends. He's not saying go buy a high dividend ETF. Instead, he's just saying buy this. So what about dividends? Now, Warren Buffett has tons of companies that pay dividends. We have banks, we have airlines, we have these kind of more traditional value companies that pay dividends. And in his 2012 letter, he actually says he does not care if a company pays a dividend or not. That's not why he's buying the company. There's a huge miscommunication on this. Watch my video on how I earned $6,000 in dividends. Dividends seem cool, right? I can go to my personal value here and I can click investment income and I can see how much in 2021 I'm going to be making on dividends. So that's money that's going to come to me. But here's the thing, that's not free money. So go ahead, watch the video. I'm going to put a card up here on it. I purposefully do not actually even want dividend stocks because I'm going to have to pay taxes on the dividend and I'm just going to want to reinvest it anyway into the stock. So I'd rather not kind of have to force a little bit of profits out of my stock, which is what a dividend is. So watch that if you're not sure. Dividends are not free money, but they just happen to be part of companies that are more value companies that have stronger balance sheets. And that's the reason why he's buying them. He's buying companies that have strong profitability and a large economic moat where competitors don't easily have a way in. Those companies often pay dividends, but he's not investing in them because of dividends. So that's the what of investing, like what you should buy for the non-professional. The when is also important. Like when should you get in, when should you get out? The main danger is that the timid or beginning investor will enter the market at a time of extreme exuberance when everything's great and become disillusioned when paper losses start occurring. So you can read the next line there, but the thing is that when things are going great, emotionally, we feel good and we want to buy when everything's going up. But instead, we should be thinking of those things as expensive. But instead, we think of them as good investments. When things are going down and people are panicking and saying terrible things about stocks or companies, guess what? We sell. But we shouldn't. We should be thinking of them as cheap. So our emotions are totally messed up with the actual results of what should happen and what the reality is. So the anecdote to this is basically mistiming. And an investor mistimes shares, and it's better just to have over a long period and to never sell when the news is bad and the stocks are well off their highs. Following the rules, the know-nothing investor, the guy that doesn't know anything but diversifies and just keeps his cost minimal in terms of fees, is virtually certain to get satisfactory and good results. Here's a better line though. Indeed, the unsophisticated investor who is realistic about his shortcomings is likely to obtain better long-term results than the knowledgeable professional who is blind to even just one single weakness. So the knowledgeable professional who knows a ton but maybe is a little bit blind in one thing, so the knowledgeable professional is actually worse off than the unsophisticated investor, as long as the unsophisticated investor is realistic about his emotional issues, and the knowledgeable professional might only be blind with one little weakness and will probably do worse. The emotions are against us. So what about if you are a pro? What if you do so much research, right? You're watching my videos, you're set, right? You're watching me, Kevin, you're watching Andre Jake, you're watching Graham Stephan, like you know how to invest. You're more knowledgeable than 99% of the people out there. Here's the thing, there is a ton of data on this. The pro investors at these hedge funds are not doing as good as the average, right? And the fees are also marking them down. So people have consistent issues trying to beat the market over a long term. Let me kind of give you a little bit of a quote here. Ray Dalio's brutally honest tip, amateur investing is harder than the Olympics. So Ray Dalio is a hedge fund billionaire, one of the most worshipped investors of his time, and he's not shy when it comes to sharing his secrets to success, yada, yada, yada. He says it's as hard as trying to win a medal in the Olympics, but amateur investors think they can do it. Like, that's how crazy it is. So you also want a little bit of a perspective here. Warren Buffett said on individuals who can beat the market, so remember, this is people that are saying, hey, buy this, sell this, actively trade this. Warren says there are, of course, some skilled individuals who are highly likely to outperform the S&P over long stretches. Okay, so it's possible. So there are people that are highly likely, right? In his lifetime, he's an old dude, I've identified early on only 10 or so professionals that I expected would accomplish this feat, right? So that's it. 10 people. I don't like those odds. So what should you do as an actual investor? Should you be putting all your eggs in one basket of dividend stocks? Probably not. Should you be trying to buy and sell and go crazy on call options? Right? Simply put, Buffett believes you should buy a low-cost index fund like VOO and just hold on to it. He recommends you buy through dollar cost averaging, which means you just keep adding to it regularly. This is what I do. Every Monday, I deposit the same amount into my index fund. And I do that every Monday, whether the market goes up or down. Warren Buffett started buying stocks on March 11th, 1942. That's when he bought his first stock. It was the best thing that he could have done would have been just to buy the S&P 500. If he invested 10K at that time in the S&P 500, and he automatically set to reinvest dividends, which is what I do, by the way, for all of my purchases. Automatically, there's an option, reinvest dividends. 10K in March 11th, 1942, when Warren Buffett just got started, that would come to $51 million now. And that would be without buying and selling, without worrying what was happening, without worrying about the news, without thinking about inflation, without the Federal Reserve printing, without worrying about any of that. It takes the right discipline, the right temperament. No one wants to get rich slow, yet compounding is the biggest magical thing that exists in our lifetime. And just buy in over time. Don't just invest a ton at one time, because you don't know enough to pick the winning times. So don't do a huge amount at one time, is what Warren says. Data has actually showed that lump sum investing, meaning putting a lot at one time, overall wins. And it makes sense because, all at one time is investing for the longest amount of time, right? You're investing now instead of a year from now, putting money in. But you're one person, right? You don't care about the averages. You want to not have that risk of being wrong in a dramatic way. So invest with dollar cost averaging overall. And I'll leave you with this. Stay humble, all right? Don't get overconfident. Don't get cocky just because your GameStop call just freaking crushed it. Please, please, please realize that Buffett thinks only 10 people have the ability to beat the S&P 500 over a long period of time. So what the heck should you do with your portfolio? Well, I'm not fully just an index fund guy. So I do have individual stocks that I believe in, and got the companies that I really understand. But I also have these index funds, right? Here's VOO, the one we're talking about. We got a quantity of this at a price of this. You can do the math there of what I'm holding with VOO. VTI is similar in that it is the total stock market. It includes companies after the S&P 500 that are smaller as well. So we have quite a bit in there as well. So that's what I want to leave you with. I invest, by the way, if you want to know my allocation, around 25% is in individual stocks. And then the other 75% is in ETFs. So if you appreciate this video, share it with someone you think could benefit. It could completely change the course of someone's financial future. I would really appreciate getting these videos. I wish we could just make these videos more popular, because these are the things that really, really matter. So I'll talk to you soon. Thanks so much for hanging out and watching till the end. This is AI, and I'll talk to you later.